All right, a very good evening, ladies and gentlemen. I'm Devang Mehra, and I welcome you to the episode 2 of WD Gann Interpretations. This is a series that I am producing on account of which I will be trying to interpret the works of WD Gann. We'll be covering a lot of books, we'll be covering a lot of journals, we'll be covering a lot of articles that have been written by the very great WD Gann in the last century, and hopefully we can have a better trading experience. So today, the topic that I'm here to discuss is what I call when getting in when the move starts. Gann has talked about this in his book Truth of the Stock Tape, and I believe it's very, very important. A small inference has been given by him, and on the page, I believe the page number is around 64 if you have the original copy. And very small influence has been given by him, but I think it's very important for traders who are breakout traders and for everyone else in the markets basically. Gann talks about accumulation and distribution, and he's talked about that for a very long period of time. If you read his articles, if you read his books, you hear these slangs coming in again and again: accumulation and distributions. And if I can quote, there is one message that he's given us through his books is the longer is the accumulation or the longer is the distribution, the bigger will be the building that is erected on top of that. So if a consolidation or an accumulation distribution is a very small one, the breakout which will happen is going to be a very small one. But if the accumulation distribution or the congestion or volatility compression, different words, same thing. If that is a very big one, which I'll show you some examples, the moves erected on top of that are also going to be massive. So that is the idea that Gann had mentioned in a lot of his works. And today I'm here to cover something. The subject matter today is getting in when the move starts. As I said in my last episode, we're all small money, right? No matter how much money you put in, unless until you don't have any proprietary experience, if you are not handling a big amount of wealth, you're all small money, and that's the sad truth about the markets. We will get chewed. So these are some rules that he has mentioned, which I think are something that we should always fall back upon. So I'm going to read it out to you. Hopefully, it makes some sense, and we can show some examples so that this corroborates what Gann has said. So Gann said, many people see a stock start advancing and they wait for a reaction on which to buy. But what happens? The reaction does not come and they get left out. Reactions, cross currents, or reverse moves, they will only take place during accumulation stages or distribution stages. I'll give you the background. You see a stock breaking out. Anything you trade up in a particular asset, you see that asset breaking out, and you're always, I've seen the major component of the retail traders. What we like to do is we don't like to immediately get on the train and buy the breakout. We generally wait for something like a small dip or a small correction, which gives us a second time buying opportunity that comes in, or what we call in technicals a retest of the earlier resistance as support. So we generally start to wait for those levels to come, and they do come sometimes, but more often than not, those levels never come. So that's what Gann said. The reaction does not come in. We get left out. And these cross currents, reverse moves, reactions, corrections, dips, they only take place during accumulation stage. Accumulation stage is, one of the first, what Charles Dow also discussed about that, before the participation in the stock starts by people like you and me, by the general public in the market, a lot of people who are referred to as the insiders, or people who have knowledge about matters of the company, who are directly involved with the dealings in the company, when they do understand a couple of fundamental developments happening, they start to accumulate stocks. So for example, when the global market started to crash after COVID, and they started bottoming out in March 2020, sorry, no one knew that would be the bottom, but there were some people who had some information. There were some people who knew how the economies were like. They knew what the growth prospects were like, etc. So that is when the accumulation started to happen. And after accumulation, when the accumulation kind of breaks out, that is when the participation happens, when you and me start to get on board the journey. Because you and me can never find the top and bottom. We can always follow the trend. That's what everyone says in the technical. That's a basic presumption of technicals. Your history, history repeats itself, and trend is your best friend. So when the accumulation stage is completed and the stock moves out of the accumulation, it will not react much. Why? Because the insiders, they've already done all the reactions that they wanted in the accumulation stage. And that's the beauty about it. when the markets were making lower lows in the COVID time, when the COVID pandemic crash started, there was a time between starting of March to the end of March when the markets were moving in a sideways to a small range, and the markets were giving a lot of reaction that point of time. At that point of time, you and me, how do we think? We think markets are going to fall, they're not going to stop down, our money's going to get lost, so let's not put money in the equity markets, let's put money in assets that are safe, something like commodities. Let's put money in safe assets like debt, etc., which is going to give you yield a safe or a constant amount of return no matter what the markets are doing. So what happens is, when the markets move out of accumulation, it will not give any reactions because they're already done in the accumulation. The insiders have bought all the stock, and what they want is that their next objective point is to move it up to the distributing level where they can start to sell. So when the stock starts to break out of the accumulation, they will keep on driving the stock higher, 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 because when that accumulation break happens, the volume of sales will be massive. It's going to be much more than average, much more than what is required to move the stock significantly higher. And the insiders or the professional money, their goal is simple: to get the stock now to the distributing level. Because, for example, let us say they bought 100 crores or whatever, 100,000, 100, 1 million worth of shares they're already bought. So now they're not going to keep on giving you dips because they've already done all their buying in tranches. So, when I say tranches, it basically means, so if I want to spend, like, let us say 100 crores on ITC, a share like ITC, I'll buy 25 CR right now. After another dip, I'll buy 25 CR. So I'll keep on buying in tranches. So they've already done the tranches. Now the job is simple: get the price from level A to the level B that they feel is something where the market should distribute. They do not come back to let you or anyone get else on the moves. Sorry, they do not let you or me, anyone, come back or else get on once the move starts. I'm sorry, I read it out loud. So they're not going to wait for you eventually. That's what they're saying. This is something very important. I love him for his references that he gives out in all of his books, the biblical references and all these examples. And one thing I would say I have learned from Gann, if you learn from me in any of my from my YouTube videos or in any of my programs or even on Telegram, I always tell you one thing: try to look at the stock markets as something very similar to real life, because eventually the markets are a combination, I would say, of people, right? Buyers and sellers, and buyers and sellers will have psychology and all these macro issues. So this is nothing, it's not a different area, it's not something entirely different, they're all connected. So try to, whatever you do in your daily life, try to combine that with the market. That's what Gann said: he who hesitates in the Wall Street is lost. Therefore, when you see a stock starting to move, if it is very active, the volume of sales are good, and the volume of sales are large, do not wait. Buy the market, buy at the market price. Don't keep putting a limit order that the market's going to come and I'll buy. Don't do that, because the markets are not going to give you opportunities. The same rule also applies to selling. When a stock breaks out of the distribution, so you will never know what is accumulation or distribution. The idea would be, let the move happen for you to infer what that is. But if you're long on it, if the stock breaks out of distribution or it breaks down, and if you're long on that stock, sell it out, go short and sell that stock. Don't keep waiting, because the stock's not going to come to just a higher level just for you to exit. The example that he gave is very, very simple. No more than 20th century train. It's not going to go back to the Grand Central Station in New York City to let one passenger get on board after it's 20 miles out. You're not going to have a train going 20 miles out and coming back to the first stop so that you can get on board. It's not going to happen. It's real life, guys. This is real life. This is how brutal the markets is. Either you're in or either you're out. Don't hesitate. That's why, when you come to the market, do your homework. Don't think in the market. A lot of people make this mistake. They keep on thinking in the market. This is happening, I'll do that. Don't do that. So you must either, get on when the hauler says all aboard, or you are left out. And this principle certainly applies to the stock market. Of course, you must study the stocks and be able to determine these moves when they start. That's the most important part of analysis in the markets. As a rule, when the accumulation or distribution is finished, the move is underway, you can make a lot of money in a 1 or 2 months time frame while the run is on, because the move is never going to stop until that stock reaches a level of distribution. I have the charts of Nifty right in front of you. And I want to show some examples about accumulations that have happened in the past and the moves that they have given, how the markets don't stop, what Gann has basically discussed in his book, Truth of the Stock Tape. So if you observe over here, this was the consolidation of the June, July to August, a good 3 month consolidation. And it's difficult to make money in consolidation because our strategy is very simple. You buy low, sell high, buy low, sell high, and you don't wait for a breakout. And this is what Gann said. He said, when the markets are accumulating, the markets will give you enough reactions and cross currents. But that is going to happen during accumulations. That is going to happen during distributions. But once it breaks out of the accumulation, then it's not going to happen. Then it's not going to happen. This is what Gann has laid the idea on you. So if it breaks out, this is not the time for you to keep on wondering, what do you do? So one thing I can explain, or one thing I can guide you, is what I have learned or I have observed in my experience in trading, whatever small experience I have, is that I generally don't like to trade such moves. So I don't like to trade a breakout that happens like that. I always, want to follow this principle of Gann's building erection, that I would like my markets to first accumulate and then break out. That is something I wait for. Longer consolidations give you longer breakouts. So that is one idea that this is my interpretation of what he is trying to say. You can again look at this time period over here, a very interesting time period for the entire global markets. 15th February all the way till the April 20th lows. This was basically when the bond yields in America started to surge. And this was a time when the bond yields touched around 1.8 in America. And what basically happens when bond yields start to surge, when the dollar starts to get strong against the other currencies, the big players like the foreign institutional investors, they'll start to pull out the money from the emerging markets like India. So we did get a good correction in the market, but this was a great accumulation as well. And you can see once the accumulation broke out, the markets don't stop. It just goes higher, 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 higher. Because to prepare this move, markets have given ample opportunities to the insiders, ample opportunities for small money to keep on buying. Look at the reactions that come in the accumulation, and look at the reactions that come in after it's not there, is the idea what I'm trying to say. So this was basically the mini taper tantrum kind of time when people were getting concerned. Basically, tapering means when the Fed's action to reduce bond purchases. So what's happening right now is that a lot of stimulus has been introduced in the markets since COVID to give the market some kind of support. That's why the markets, there is so much liquidity and the markets are going higher and higher. But when the Fed start to taper, that does become a matter of concern. So I will do a video on that a little bit later. But when the tapering starts, so I think tapering is starting from next month, which is November, till the middle of FY22. So you will have to have a different kind of allocation, a different set of long short kind of portfolio, so that you benefit from these kind of movements. You can see another consolidation in Nifty as well. I'm showing the Indian markets, but the concept is same. So once the accumulation was happening, you can see over this resistance, a good amount of accumulation was happening over here, and the markets gave you enough retracements, they give you enough reaction. But when it broke out, it doesn't stop. So don't hesitate, is all I can say. A lot of people do have this, you have this paradigm, I would say, that when the markets break out, it's too expensive. But remember what I have to say: expensive will always remain expensive, and cheap will always remain cheap. Don't forget that. A share like penny stock, if there are 100 penny stocks, 99 penny stocks will remain penny stocks, or their going concern will be impacted. But expensive stocks like the big blue chips, like the big mid caps, they're going to remain blue chips, or mid caps are going to become blue chips in the future. So expensive will remain expensive. If the markets are showing you that they want to go out, let them break out. Don't keep questioning it. Don't have your own kind of sense of overvaluation that the markets are too overvalued. Don't do that. I can show you another example of a couple of stocks that I have traded, and have had some good time in that. I think Bosch is one good example, one of the automobile companies in our country. And I think this is another good example of the accumulation distribution thing that happened. So you can see over here, the markets gave you enough retracements. It gave you enough reactions when the markets are either accumulating or distributing. But once that sets out, that breaks out, it doesn't give you a lot of time. I think one of the recent examples is Page Industries, something I've talked about on Telegram for a very, very long time. And you should check my Telegram, I would say the last week, which is the 1st October to the 10th of October. This is the idea that we floated to all of you. A big accumulation happening in the page industry. So what was happening is all the textile makers in our country, they were mulling higher prices, which eventually were being passed on to the consumers, supply side inflation. So this was a big accumulation. And when this news was finally out, cabinet approved, you saw very, very big momentum. And this didn't stop. Now, when the markets go higher, people again and again start to question that now the price is too high. But the thing is, it's going to keep on going higher and higher and higher. So this is what Gann says. To conclude in a minute or in 30 seconds, I would say that. So when the markets are moving in accumulations, try to enter stocks then if you have a risk appetite. If you have a risk, but have a stop loss always. Have a stop loss below accumulation or distributions or above distributions. But if you're a risky investor, try to enter a stock during accumulations. But when the market breaks out, if you're a cautious trader, I would say you just get on board. If you have, let's say, 100,000 account, if you want to spend like, let's say, 100,000 on the trade of Page Industries, I would say at least a 50, 60K should be coming in right now. And maybe a 30K or a 40K balance could be something that you can invest when a new tranche comes in. Or what I mean by that is in the future, if the market does give you a dip. But I would say if you have a 100K account, 60K or something must be coming in right now when the markets are showing you way, when they are giving you way. Don't let your emotions stop you. So that's all. That's about the lecture that I had today, getting on when the move starts. So I hope you enjoyed it. Please make sure you like, share, subscribe, comment if you had a good time today. I'll see you tomorrow in the episode 3. Cheers, guys.